Welcome to Simply Wealth, the podcast that's simplifying the complexities of your financial success. My name is Cory Cook, CEO of Cox & Cook Wealth Advisors here in Dublin, Ohio. Please enjoy the episode. Welcome to Simply Wealth, the podcast where we're simplifying the complexities of your financial success. Today, we are discussing the state of the union of our industry. And with me is Dan Cox, founder of Cox & Cook Wealth Advisors, multiple decades of experience within the industry, and you've seen it all. And to kind of jump into this whole topic, our industry, point blank, is kind of the Wild West, unfortunately. It shouldn't be that way. There was legislation passed in 2009 with the Dodd-Frank Act that should have solved all of that. And unfortunately, it was gutted by the administration that passed it and finished off by the next administration that brought it in. And there's a stigma within our industry, rightfully so. You see it in the movies. You feel it when you're out there from stories of other people that you've talked to that have been taken advantage of. There's this broad spectrum of expertise, knowledge, services offered that most people may not even know that should be offered from their financial partner, strategic partner. And so it's a very hard time to be a client, a potential client out there, because you don't know, what am I getting into here? I have apprehensions because I saw that movie. I heard this story, all these things that are happening. What questions should I be asking? What type of professional should I be looking at? They're not really educated into our industry or aware of the current state of our industry and what's out there. So I'm going to ping pong this over to you. A lot of clients aren't even aware that there are different standards within our industry, right?
Yeah, that's so true. It's so confusing to clients because they really don't know that difference. And there's two primary differences, and we believe as fiduciaries, we're fiduciaries. That's the best standard. We'll come back to that, but there's also the suitability standard, which is full of conflicts of interest. And when somebody is compensated based on a product, that's a concern. So it might not be the best product for you. It could be suitable for you, but from a fiduciary standard, we wouldn't do that. So you want to go with somebody that how they're compensated and what types, and the products shouldn't matter. They really shouldn't matter. So it should be the products that a fiduciary puts you in are products that he would put his mother in. If a suitability guy or gal, that may not be true always. There's really conflicts. So, and I know that there's some companies that, hey, if you use their mutual fund or their especially variable annuities, there's extra things that you get out of that: healthcare, 401k match, stuff like that. So that's a big conflict. So a pure fiduciary eliminates that. There is no compensation based on products at all. So it's a better way of doing things. So we call it a win-win. When the client does better, we do better. And there's that's stealing a tagline from somebody else, by the way, but that's so true. So that's a true fiduciary. That's a better way of doing it for sure. Now there's a third way of doing it we call it a hybrid. It's a little bit of fiduciary, a little bit of suitability. So you really don't know where they're coming from, and that adds more confusion to the mix. So the bottom line is it's better to find a fiduciary. And if you're in a transition period, and you should probably interview 3 different firms, figure out whether they're fiduciaries or not. And it's more than just, hey, I like this person, they're well dressed, or they've got hair like Cory or no hair like Dan. It's are they a fiduciary, and what's their experience in that area, for sure.
Yeah, it's the word fiduciary wasn't on anybody's lips 4 years ago. Now it's all over the commercials, and just as a base to this, fiduciary by definition is just somebody that's legally obligated to do what's in your best interest. Mm-hmm. So when we're explaining to a potential client the differences between a fiduciary standard and a suitability standard, well, you're managing my money. You're legally obligated to do what's in my best interest. really isn't the case, is it? So that's a big deal. We used to have a pretty firm no friends and family policy, right, with the
Yeah.
company, and had a lot of friends, a lot of family members that said, well, if you're not going to take on our account, can you help us out? I mean, what are some of the things that we should be asking for? Help guide us to where we should be looking, And it was always first and foremost, ensure that it's a fiduciary, somebody that's legally liable to do what's in your best interest. People that are audited and vetted to ensure that they're not just talking and not walking the walk. There are actual bodies coming in, whether that be the SEC or whatever state that they're in, or coming in and auditing and pressing them on, is that the most efficient investment? And that's another key thing. Investments, or is it products that are out there? With fiduciaries not receiving commissions, you're legally not allowed to receive commissions. You're not selling products. Products pay those commissions. So we're looking at investments, things that are actually going to be more efficient for you over the long haul. And so that's a big deal, right? We have a lot of clients that come in and say, outside of that scope as a fiduciary, you need to have a Loctite estate plan. You need to have a Loctite tax planning plan, insurance plan, long-term care.
Yeah.
A lot of these other advisors at this end of the spectrum that have low expertise, low knowledge. And no offense, some people can study for a handful of weeks, pass a series exam, and they can get the title of investment advisor, financial advisor, whatever, advisor representative. Their business card looks exactly like ours, nice suit. They went to a photographer. They got a website. And they go and work for a company that a lot of people see their commercials on TV. They see their buildings in the strip mall down around the corner.
Yeah.
Okay,
Yeah.
those types of companies. They put together these plans for you that are involving mostly products.
Yeah.
They get a big commission up front. They get commissions in the middle. They get commissions on the back end.
And those clients that come to us from that firm or those firms, they're all the same. They're in the same investments. They're in the same annuities, same insurance.
Yeah.
It's kind of a packaged product that they do. So
And it's a lot of bewilderment sometimes too. I wish I had known this sooner. I wish I had known this sooner, this education. And even talking about all the other services provided. We've got a lot of people that we talk to that may walk through the door and have a conversation with us that frankly say, right, Tom, I had no idea people like you, right, did these types of things. I just thought you were stock jockeys or whatever. Hand me the money. I'm going to put you in this thing. And, I might may talk to you once a year about this. That's not the way to go. There are better options out there for people that actually care about your long-term success, and maybe not just your success, true legacy planning, generational wealth planning, so that a lot of times we're working with mom and dad, the kids, the grandkids, and even some cases now great-grandkids. That's a true generational wealth strategy. And, if you don't have all the pieces of the puzzle, you're not going to be able to put together the final unit, right?
Yeah.
And having a bad estate plan, having a bad plan over here for taxes, just one piece missing derails the whole thing.
Yeah.
So, that's a big deal. It's one of those things that we run into on a weekly basis, right? Of talking about these things. So,
hey, Cory, if I can cut in here real quick. I know we just, I don't know if it was yesterday or Monday, we just had some prospects and had the conversation. I think we say this in a lot of those concept interviews, but to what you were alluding to, Dan, go meet with other advisors, and some may or may not call themselves fiduciaries. So if you guys could give some advice to those people shopping for an advisor, what are the types of questions they should be asking to really figure it out? And one other piece I wanted to throw out there too is, and you mentioned the hybrid thing, if you can explain that more. And if I ask somebody, hey, are you a fiduciary? And they say yes, how do I know if they are a true fiduciary like we are, or one of those hybrids you mentioned?
Well,
I'll take the hybrid answer.
yeah.
Why don't you start out with the questions that you should be asking?
If I'm a prospective client and I'm interviewing like 3 different groups, the first question I would want to somehow ask is how are you paid? Okay, do I pay you? How does that work? Is it a share mutual fund? Where I pay a front end load? How does that all work? I want to understand that.
Are there any like red flag phrases or terms that type of person should be aware of to know to look out for?
Annuity. So there is a lot of fear around markets all the time, unnecessarily at times. And so annuities have come up as a way to lessen risk. But really, in our opinion, they're really good for the person selling them in the annuity company. They're not really suitable, in our opinion, for all clients. Okay. And because they pay very high commissions, and there's no management of it, there's no, they're just selling a product to get a commission. And there's nothing that you can do in open markets that you can do a synthetic annuity without the cost if you wanted to do that. So there's no reason to do a variable annuity in most cases. There are some cases, but they're very much oversold. So if you find out that, hey, yeah, these annuities are the best thing for you, I'm like, hey, what other alternatives? So the other question I would ask is, what licenses do they have? Okay. If they have a Series 6 license, they cannot sell you a stock or an ETF. Okay. So why is that? Well, if they have a Series 7, they can do pretty much everything. Series 6 is more limited. So you want to go with somebody that's not limited. Okay. And you also want to go with somebody that is not paid a commission, right? That's fee only. Okay. As we are, where they, we are paid based on your assets. So if your assets grow, our fee goes a little bit higher. You're happy and we're happy. And at times too, we charge an hourly fee depending on the situation. So that's a better way of doing it. So what other questions would we ask?
Well, how about some basic questions of, why are you in the industry? What is your background?
Yeah.
Finding out their story. This is supposed to be a long-term relationship.
Yeah.
So, it's one of the questions that I always had on my sheet is find out about the person, get to know them. You have to be comfortable with that person, have an understanding of who they are, what their background is, what they do in their free time. It could be a number of different things. Would be a big one.
I'll add one other thing. We kind of joke about this, but we kind of have with our clients are prenuptial, meaning that if they leave us for whatever reason, we reimburse them the fee that for the days that we weren't managing their account. So they're out nothing. If they leave a person where they paid a commission, there could be back end charges. You could be down your 4-6% off the bat because they've already been paid. So it's good to go in knowing that you have a prenup, I think. So where if it doesn't work out, then you don't get hurt financially. Yeah.
And even asking about, say, conflicts of interest. I mean, bring it right to the table and say, can you please explain to me any potential conflicts of interest that you have based off of the model that you run? Because, well, again, a lot of clients aren't aware there's guys that are called captive agents that typically work for the investment company or insurance company. There are independent agents that they're independent in with their own firm, but they're coordinated or working with something called a broker-dealer, right? And a broker-dealer, there can be conflict there because they ultimately have that relationship with them and they can force things down their throat. You need to be, XYZ investment company came in, they paid us a bunch of money to get shelf space here with this company. You need to be writing 15%, 20% of your business into this product or these mutual funds because they get kickbacks. So there's conflict of interest there. All the way to the other side of the scope, and the furthest end is it's called an RIA or Registered Investment Advisor, true autonomy. The only people that you answer to are the policing bodies. It's the state that your advisor may be in, or the SEC, depending on the assets that they manage. But
And the client.
yeah, and the client, and where they're at. But they, just finding out what their structure is and what conflicts of interest that they have in place, and that kind of parlays and jumps into your question about dual registry, or what we call a hybrid advisor. The industry has really wised up over the last few years because a lot of those guys that are affiliated with broker dealers, captive agents, those types of advisors, they've been losing clients because people want to work with a fiduciary, somebody that has legally obligated to have their best interest in mind, the most efficient investment selection out there. And these people are just consumed by all of this data. They've got no idea what to pick from. And they sit down with these advisors now, since they're hemorrhaging, and they say, yeah, I'm a fiduciary, Dan. I'm sure I'm a fiduciary. A portion of this broker dealer now has spun off a different division that is an RIA, a registered investment advisor, but they still have the good old fashioned, broker dealer platform over here too.
Yeah.
So they're, in essence, they're wearing two hats.
Yeah.
And it becomes, again, very confusing, Tom, for this person that's sitting down at a table that might not be educated in the industry. They're new to all this. They're already have anxiety, and they don't know what hat that they're wearing, or the advisor might not be doing a very good job in explaining to them what hat they're wearing at that point in time, to where they can still sell you that annuity and make a 10% commission or an 8% commission, but they can call themselves an RIA because, well, this bucket over here, you see, we're going to be doing an active management with it and charging you a fee as a fee-based. So how can you get around that? You need to be asking for their Form ADV, do some due diligence as well, which we'll have attached to this podcast, a link to be able to vet for RIAs, because you can look them up. They are registered to confirm, just like FINRA broker check, which some of you may be akin to already, but there's an actual resource similar to broker check for RIAs or fiduciaries as well. But ask that financial advisor immediately. They have to legally provide it to you during the first meeting. Form ADV Part 2A and 2B. The 2A is for the firm level. The 2B is for the representative level. That provides all of their background, their scope of services, any disciplinary actions, any criminal records, anything like that that's out there. So request those forms ADV, read through them. If you have questions about it, there are resources that you can contact to find out about those. So
The biggest thing for prospective clients is you have to work at this. So it's a big decision on who you're going to place your trust with, and number one, make sure you have a prenup, because sometimes your emotions get the better of you. Hey, I don't want to go through all of this. It's confusing. I'm just going to go with that guy, and don't get in a situation where you can't get out without free. You can't get out free. So we never like to put our clients in a situation where an investment that, hey, you got to stay in it for X number of years ever. So we want as much liquidity for the client and flexibility as possible, because we would.
Yeah.
That's what we would want.
That's right. Yeah. Dan eloquently created this concept, or what he called his mantra, many years ago, called the Fred test. Fred was his dad, and it's that simple. If it wasn't in Fred's portfolio, it wasn't going to be in our client's portfolio. Yeah. And outside of simplifying the complexities of our client's success, that's probably mantra number 2. Yeah. How we're invested with our own money, our own family's money within our firm. Our clients are in the exact same types of things. We're not out there peddling and have that conflict of interest, trying to sell commissionable products. We don't have to bring 2,000 clients through the door every year to make enough commissions for whatever salary that we're looking for the year.
Yeah. We don't do seminars, so right. the people that do seminars are commission people, because they need a steady flow of new commissionable people. So we don't have people that we sell things to. We have clients that we're responsible to and for. So that's a big difference, I think.
That's right. There's a lot of sneaky ways out there where we're talking about that spectrum, where some of these advisors, that conflict of interest, where, boy, I'd really like that bass boat, come fourth quarter.
Yeah.
let's look at the client list here and see who's got XYZ mutual funds. We should do some rebalancing here.
Yeah.
Right. Some rebalancing.
Yeah.
Get a new 5% upfront commission, selling some type of like an A share mutual fund. That's the other confusing piece. Mutual funds, A shares, B shares, C shares, I shares, Z shares, loads, 12B1 fees. It's all these things that add to the confusion within our industry. And as a country, I do personally believe that we have done an awful job in educating the populace on just the basics of finance. And a lot of financial advisors are now giving their time to schools to help out the young folks, and teaching them the basics about compounding interest, why saving is a good thing, and illustrating that to them. The downfalls of debt, credit cards, things like that. You need partners in this and education. So we've done a very poor job in educating people on. We have people that walk through the door that are 70 years old that might not have a firm fundamental concept of how basic money management works or investing. It's too complicated for people, and you got to make sure that you're working with somebody that is qualified. They can show you that they're qualified, and that you feel comfortable with them. Knowing that I just have a very good feeling with these people. They were very upfront. They're not just selling me lollipops and rainbows and unicorns.
Yeah.
These people are genuine, and you can tell.
Yeah. Agreed.
But yeah, that's crazy times to be an investor. That's for sure.
It's also a great time to be an investor.
That's right.
I'm excited for the future. There's a lot of negativity out there, but if you're 35 right now, or you're 40, right? So it's the best time. Technologically speaking, the breakthroughs that we're having is going to be awesome. I think it's the best time to be alive.
That's all I've talked about in all of our client reviews and meetings that we've had for the last month and a half, is the world is going to look completely different 10 years from now than what it looks like today. It's not all going to be for the better. There's going to be some things out there that we wish we had maybe done a little differently, but we're going to see a drastically different landscape, and I'm a glass half full guy, I believe, for the better, and in a multitude of ways, and the opportunities are abound. That's for sure.
Agreed. Yep.
Yeah.
Good.
All right. Well, we appreciate you joining us today with the Simply Wealth podcast. Tune in for the next episode.
Cox Financial Group, DBA Cox, and Cook Wealth Advisors is a registered investment advisor located in Ohio. CCWA only transact business in the states in which it is registered or qualifies for an exemption or exclusion from registration requirements. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Be sure to first consult with a qualified financial advisor and/or tax professional before implementing any strategy discussed herein. Past performance is not indicative of future performance. Case studies presented are purely hypothetical examples only and do not represent actual clients or results. These studies are provided for educational purposes only. Similar or even positive results cannot be guaranteed. Each client has their own unique set of circumstances, so products and strategies may not be suitable for all people. Please consult with a qualified professional before implementing any strategy discussed herein. No portion of these case studies is to be interpreted as a testimonial or endorsement of the firm's investment advisory services.